各位国泰世华银行的贵宾及线上的朋友午安，我是国泰世华银行财富管理部李鼎伦，非常欢迎各位参加我们2021年下半年全球投资展望线上论坛。今年全球金融市场在 Reopen、Reflation 及 Re-rating 3个 R 的助攻下，全球股市跌创新高，利率走升，原物料价格也持续的走扬。那同时呢，带来了通货膨胀以及市场过热的担忧。那随着景气进入了下半场，那投资人在资产配置上该如何布局，掌握投资的先机？希望能透过这1小时的交流，让大家有丰富的收获。在论坛开始之前呢，我们先邀请国泰世华银行李伟正总经理来帮我们致辞。
大家午安，欢迎参加今天2021年下半年全球投资展望的线上论坛。新冠疫情在5月有戏剧的变化，改变了你我的生活。是的，这次病毒离我们这么近，让人如此焦虑不安。身为国内金控领导品牌的国泰世华银行，有多达1200万位民众将宝贵的资产托付给我们，因此我们思考能为您做些什么。英国前首相丘吉尔曾说：“危机就是转机。”危机迫使人们求生存，用更高更广的视野寻求解方，进而战胜危机。所以今天我们筹划线上的论坛，邀请国泰金控长期友好的策略伙伴橡树资本的共同创办人 Howard Marks， 为台湾广大的投资人带来最新的市场观察。同时由国泰世华银行首席经济学家林启超分享国泰世华银行下半年市场展望，希望东西方大师的专业看法能化成正向力量，协助你定心思考投资下一步。相信接下来60分钟论坛能给您许多收获。最后祝福大家平安健康，谢谢。
好，那谢谢总经理。那这一次论坛呢，我们很荣幸邀请到价值投资大师，也是美国橡树资本的共同创办人及董事长 Howard Marks 与国泰世华银行首席经济学家林启超来跟我们分享精辟的见解与看法。Howard 我相信大家对他都不陌生，他写给客户的投资备忘录一向是投资业界最关注的焦点，而他2本著作《投资最重要的事》以及《掌握市场周期》也被视为价值投资的圭臬。然而今年受到国内疫情的影响，我们也是首次尝试用线上的方式进行。为了让会议的流程更流畅，那我们近期呢已经跟 Howard 进行线上的对话，并透过预录及字幕的方式来呈现，让大家不用透过线上口译就可以接受到大师的真知灼见。Howard 呢也很慷慨回答5个投资人最想问的问题。接下来我们来看看 Howard 的分享。
Hello, I'm Howard Marks, co-chairman of Oaktree Capital Management, and it's a pleasure for me to be with my friends from Cathay United Bank today. My topic for today is investing in a low-return world. This, in my opinion, captures the essence of 2021. The most important single characteristic in the financial world is the low interest rates. And the low interest rates have had a very strong effect by raising the prices of most assets and reducing their prospective returns, and by inducing risky behavior on part of investors who are trying to achieve a decent return in this low return setting. That's the topic that I'm going to pursue today. We all know the history. Just on February 19th last year, before most people understood the risk from the coronavirus, the S&P reached an all-time high of 3386. But over the next 4.5 weeks, the index lost 34% of its value, falling to 2237. It had made the fastest trip into bear territory in history. The Fed and Treasury announced massive support in mid-March, and a powerful rally began on March 24th. The S&P returned to bull territory, that is up more than 20%, in a record 2.5 weeks. On August 18th, it hit 3389, surpassing the previous high. On December 31st, it was 3768, up 68% from the low, with a return of 18.4% for last year. And on April 23rd of 2021, it traded at 4194, up 87% from the low in only 13 months. The world has been combating a very serious pandemic, the worst economic contraction of the last 80 years. The economy is still slow. The pandemic is has not been solved yet, although it seems to be coming under control. Yet the stock market has been able to compile a record advance and fly past the all-time high. And that high was achieved when the economy was humming and the outlook was rosy and the risk of pandemic had not registered on investors. How could that be? How could the markets be doing so well in such a difficult environment? Well, the answer is, number one, investors have placed great faith in the ability of the Fed and Treasury to produce an economic recovery. Everybody has concluded that it is in process. The statistics on COVID-19 and deaths have been going in the right direction. There's optimism with regard to vaccines, tests, and treatment. A little slower to roll out in certain part of the world than elsewhere, but everybody's optimistic that the vaccine holds the cure. We see positive economic announcements and resulting optimism. And overall, investors were happy to look past the valley to a time when the earnings for the S&P would exceed what they were in 19 and had been expected to do in 20. We also have had positive news from interest rates. Everybody became convinced that interest rates would be low for a long time. And the Fed indicated that they would be kept low and there would be no rate increases through 22 and possibly 23. And some people think that short-term rates would remain low for 5 years. And as I said before, there are several impacts. They raise the discounted present value of future cash flows. They bring down demanded returns, allowing asset prices to rise. When the Fed is buying bonds, as it has been, it's buying bonds at $120 billion a month now. Their rising prices and falling expected returns have this very salutary effect on most asset classes. The Fed buying puts money in the hands of the sellers, which they have to reinvest, going back to the markets. The low prospective returns cause a reawakening of risk tolerance and a reaching for return, because people are trying to get those decent returns. And the effort to put money to work causes the capital markets to remain open. In past crises, there have been capital market crises, what we call credit crunches, and this time that was averted. So all of these are ways in which the interest rates and the Fed and Treasury behavior have supported the markets. Why are prospective returns so low? It's simple. We talk about something called the capital market line. It looks like this. The vertical axis is return, the horizontal axis is risk, and the line slopes up and to the right, suggesting a positive correlation that as risk rises, expected return rises. Now, I think that people make the mistake of saying that riskier assets have higher returns, because if riskier assets had higher returns, then by definition they wouldn't be riskier. Rather, riskier assets have to appear to offer higher returns or nobody will buy them. They just don't have to come through with the higher returns, and that's what makes them riskier. But anyway, we have this upward sloping return. We have the asset classes arrayed along the capital market line in order of their riskiness, so that if you want to get a higher return, you move towards an asset with a higher expected return, but of course that is uncertain. That's the way the market looked, I don't know, 10 or 15 years ago. The line emanates from the risk-free rate, and the Fed brought that down to zero in March of last year, and so the whole curve shifted down. And now the returns on every asset class are still at equilibrium with each other, just at the lowest rates we've ever seen. And that describes the conditions today. Asset classes fare relative to each other, but all prospective returns very, very low. We often talk about a rally, and in the first stage, only a few people understand there could be improvement. The second stage, people know that improvement is taking place. Third stage, everyone concludes everything will get better forever. The first stage began in February of 20 and culminated on March 23rd at the low, but since then, some people believe we're in the third stage. The market's valued in a way that focuses on the positive and accepts them as true and overlooks the negatives, and of course that in itself is dangerous. Markets are low when people are pessimistic. They can be high when people are optimistic, as they are today. I believe that we're back to the conditions of 2019 or 18, at which time I was saying that the returns are high, and the uncertainties are high. The prospective returns in many asset classes are low. Asset prices are full to high, and people are engaging in pro-risk behavior, which makes the market risky for all of us. So this is a cautionary message, and I think the bottom line is we're living in a low-return, high-risk world. So what are the investors' choices in terms of behavior in such an environment? And I believe that there are 5, and I believe there are only 5 possible actions to take at the present time. Number 1, invest the same as you always have and accept that today's prospective returns are lower and that your returns will be lower than they have been in the past. Number 2, in deference to the riskiness of the market, reduce your risk to prepare for a correction and accept even lower returns by going into higher quality securities and safer strategies. Number 3, due to the risk, go all the way to cash at the near zero return and wait for a better environment. But of course, few of us want to be in cash when the return on cash is pretty close to zero. Number 4, increase your risk in pursuit of high returns. Is this really the time when you want to increase your risk, when asset prices are elevated and prospective returns are low, and risk premiums, the reward for taking incremental risk, are low? Finally, put your money into special niches of the market with special investment managers who you think have the skill to get good returns and protect you from risk. Now, none of these alternatives is completely satisfactory. They all have some drawbacks, but I believe there are no others. So we have to be realistic and choose from among these 5. My own choice would be some combination of 1, 2, and 5. That is to say, steady as you go, perhaps a little leaning toward risk reduction and looking for better aspects of the market, because some things are cheaper than others, and there are market niches where investment managers with skill can help you. But bear in mind that when you go into the special niches, number 1, most of them are illiquid, which means that you lose access to your cash for some time. And number 2, you depend heavily on the managers. If they have skill in these special niches, they should be able to make a special return for you. But if they have no skill or negative skill, that is, they tend to make bad decisions, it can be costly. So going into number 5 introduces liquidity risk and what I call manager risk, the risk of choosing the wrong manager. But as the summation line at the bottom says, there are no alternatives, even though none of these are completely satisfactory. In order to pursue a high return, think back to the capital market line. In a low return world, requires the assumption of additional risk. There's no question about that. And the choice is largely with regard to the form of risk. For example, there's fundamental risk attaching to the companies and their profits. There's interest rate risk. Higher interest rates, all else being equal, call for lower security prices. There's liquidity risk, the inability to access your money. There's manager risk, dependence on the manager for performance. Today, everybody wants a high return and is willing to take on risk to achieve it. That fact in itself precludes the existence of low-risk solutions. And everybody's trying to get these high returns. That has implications for your risk that you should have to be realistic about. The bottom line for me is as follows. The Fed will continue to support and stimulate the economy and markets, and interest rates will stay low for a good while. Low interest rates justify high PE ratios. No one knows what the long-term ramifications of the Fed and Treasury really will be. In particular, there are risks of inflation. We see some inflation. Will they prove transitory or semi-permanent? And do we really have to worry about them in the long term? The tech and software sectors did extremely well. The reweighting of the S&P in their favor called for a higher than average PE ratio, but we do have one. And those stocks seem to have tired here. The rest of the market is at lower prices, but perhaps deservedly. Many of those companies still have problems, either with the pandemic or with their business models, like brick and mortar retail. The recovery from obviously cheap has taken place, and it's been dramatic, but it's largely in the past, and nothing's obviously cheap today. The short-term fundamental outlook is positive, but reflected already in the prices of most public assets. Most asset prices are fairly valued relative to each other, but as I said, all prospective returns are low. I believe that at least normal caution is appropriate, and the more concerned you are about short-term markdowns, which would come from inflation and higher rates, the more cautious you should be. We're back, in my opinion, to an environment in which public markets are fully priced based on current interest rates, but overpriced based on normal valuation standards. Regardless, their prospective returns are low in the absolute, and we must bear that in mind. And that means that if acceptable absolute returns or superior risk-adjusted returns are to be achieved, it's likely to be in private markets through the application of what we call alpha, or personal manager skill, which consists of finding bargains and or adding value through active management. All public listed securities have done extremely well. Most of them have recovered beyond their 2019 highs, like the stock market. It's easy for investors to find the public assets and invest in them, which means the money flows there, which means the money has driven them up. If we're going to find bargains, it's going to be out of the mainstream, away from the public markets. And there are, of course, markets where the information is not as readily available, essentially available where it is possible through hard work and skill to get a knowledge advantage. An example of this is real estate, because everybody knows that General Motors stock exists and everybody knows where to buy it and how, but not too many people can buy real estate or related debt for an investment. It's hard to trade in, hard to find, hard to execute. If you're sitting in your home, you don't even know what properties are for sale around the world and at what price and which ones are the attractive ones and which are not. So you can get an advantage in private markets like those, but it requires skill and expertise that many people lack. What else can we do in a low return world? And the answer is not much. I don't think we should get out of the market. I think that's too extreme. I think that if investors wish to reduce their risk, that's a reasonable thing to do. If they want high returns with moderate risk, they'll have to find it in the special markets. And we at Oaktree want to continue to help. Thanks very much for your time today.